this out, and then I got to reopen it in the morning. I should just leave 2 windows open again. Son of a bitch. Where they Matt? Oh, down 10, huh? Thank you, Matt. What's up, everybody? Post this shit. Hold on. Hold on. Title extremes. Zoom in. Boom. Boom. This. Boom. And then there's one more. Oh. Okay. How's everybody doing? Yeah. So that was crazy, right? Right before earnings. I thought it was going to shaft people, shake people out, and then, then they come out with a huge beat type shit. And think about, like, if you're holding a mat, you got a nice position, and then you hear that shit right, you're going to hold it, hold it through earnings. Market looks strong. Right? Earnings have been strong mostly. Then you get that news right before the bell. You're pooping your bloomers a little bit, but you didn't pull the trigger or hedge. It's not that, but 145. I mean, right, half the rip it gave up. All right. Yeah, right before the bell. Are you hearing an echo? That's on you, my brother. That's not me. I don't think you shouldn't be hearing an echo. We'll see if it has any material effect on the semis in general. The semis, a little interesting spot here because you're right back near top of the range. They're usually they're usually a leader of any bullish conditions. You got your buddy Berry, who covered a short in the overall market, probably into weakness, I'm sure, and now took a new short position. In video or the semis in general? I think via puts anyway, right? So we'll see. It'd be hard for the market to make much ground make up much ground to the upside without the semis participating. That's for sure. Far from the mic, it's not. It's definitely not anything I did. It might be a YouTube thing because I'm broadcasting the same exact way I was broadcasting all day. As a matter of fact, but let me check one thing. Hold on, because this is a different, a whole different shit we use here. Hold on. Mike. Oh, yeah. You guys are right. Look. How do I switch this? Hold on. I don't know why it changed on its own. I just muted myself. How do I change to this now? You can mute while recording. Let me see. What do I got to go to settings? Usually I just go to here, Mike. No, what?
The it should be all good, hopefully.
No, the mic wasn't on the right mic.
Oh, gosh, I was just saying we have to keep it recording to keep it going through to the YouTube.
Yeah, but I had to stop recording to hit the mic. So now what happened? I screwed it up.
I have no idea. We're navigating this together.
Jesus. Can you guys hear me out there now?
Okay, it should be good.
All right, good. Yeah, I had to stop recording to switch the mic with this contraption.
Okay, I'll leave you to it, Jack.
Right. Okay, see? I can wiggle my way around. I can wiggle my way around a little bit. All right, let's go over a couple things. There's nothing really new that we haven't touched on the morning live sessions throughout the week. Again, we kind of want to get a gauge on how far in the move up at the index level we are currently at, right? You never know for sure. You never know for certain. And the market, even when you have a good idea of where you might be, the market has a tendency to overshoot, both on the upside and the downside. So you have to expect to be early. But I definitely think there are points, a lot of times just based off price action, not even positioning or anything like that. But there are points off sell-offs and rallies where you're not going to get any new information from more of the same, right? It was kind of, if you remember, those of you who were around back then, when the market was ripping here, okay? And we kind of made the same point that we're probably going to see more mega cap bull flow, right? The breadth was thin, really concentrated. We were just getting through a big chase, very similar, where funds, the pros didn't have much exposure and they were, scrambling for exposure, chasing all the big names in sight. And I think we are pretty much, if not there, really close to a very similar spot. Okay. So again, could overshoot a bit, but we're not going to get any new information off the chase. Okay. What we need to keep an eye on is once the major indexes and some of these mega cap names that they've been buying, once they do show some signs of fatigue, right? Once they stop going up every day, basically, that's where I think there are going to be a lot of decent clues in the price action, in the flow, again, how positioning sentiment end up shaking out. So we got to get to that point first. We might already be there, right? This might be the start of a little digestion here, okay? And the clues we need to look for, let's start with the flow. What bulls would want to see is, again, what we've spent a lot of time talking about over the past at least year now, right? After the initial snapback squeeze, right, that scramble for exposure from funds that are underweight, okay, very common that you see what we see. This was a violent one, an extremely violent one. to say the least. Okay. But after that initial push, market has a tendency to try to catch its breath, hang out a little bit, get a little sticky, choppy, and then you look for signs of rotation or lack thereof, right? So if you're bullish, the fuel for further upside, especially in the indexes, the market as a whole, is that money starts to spill over in other places. Okay, it doesn't have any, especially now, it doesn't have to be any specific spot or spots. Okay, but what you don't want to see if you're bullish is a continuation of that chase in the same names. Okay, because even though they can go on for a little bit longer and maybe a lot longer than all of us would like, it usually almost always ends badly. The longer it goes, the worse it's going to end. That's usually the case. Okay, so if you're bullish, you don't want to see that. All right, if you're bearish, you probably want to see that, because then what's likely to follow is some violent pullback, or right. Sometimes you lead to start of bear markets when that trade gets significantly long in the tooth. Okay, if you're bullish here and you're hoping for more of this again bullish phase that we've been in, we want to start to see the buying spill into other areas. Okay, and you have several other areas where money can spill into. Now, the buyers we follow, again, but even if you look at just volume, price action, relative strength, aside from flow, there hasn't been much of any real interest anywhere else. Right? You see, usually it comes the latter part of a squeeze. You see some action spread out into other areas, and after that, right, that's usually the tail end of the squeeze before you go from bullish phase to bearish phase. Okay, what we want to see is, and we kind of were starting to see it earlier in the year in some of the underbelly growth names, if you remember. It's kind of on the price action terms, the higher lows, higher highs type of trend. Okay, and let's take the banks for example, right? So you get where they finally participate, right? A lot of these laggards finally participate. And now what you would want to see is when, regardless, whether they hang out a little bit here or they come in for a couple of days, right? So you're part of the steam room, paying attention to flow. You want to see sweeper activity support that weakness, show up into that weakness. Okay, and that's what ultimately will create. Excuse my French. That's what ultimately will create kind of this, right? Even if it's not a major bottom. Right? You know what I'm saying. And all of a sudden now, these names that have been out of favor in clean-cut downtrends start to put together some form of an uptrend. Okay? And that's the bullish case. That's what you would want to see. You want to see all of the areas of the market that have been neglected, right? As they've concentrated on the mega cap names, the Magnificent Seven, and some tech names. You want to see that sort of price action with flow confirming in other areas. Okay. And ultimately that will more than likely support markets, may not lead to further upside, because depending on what those higher beta, heavily weighted names are doing, right? Are they selling off? Are they just chopping around? Are they participating but lagging? Right? There's a bunch of different scenarios how that maybe play out on that end. Okay. So it's difficult to get a gauge on how strong the indexes may result off of that rotation. But as a bull, there'll be plenty of areas to participate in, even if the indexes aren't really doing much. Right. And I think I mentioned that to you guys a couple of weeks ago. What you start to notice is that the indexes really aren't going anywhere. Okay. They're not rallying significantly. They're not selling off. They're kind of in a digestive phase, but there are names that are outperforming. And a lot of times you're going to see those names fare even better when the indexes aren't really doing much, right? So the complete opposite of what we've seen in this initial squeeze, okay? If they are not rotating in any aggressive manner anywhere else, right? If they're not finding new places, new names to put some money to work, then I mean, just common sense, right? What you're going to see is probably that buyer strike, that term we mentioned several times over the last 3 months, and ultimately will lead to some sort of pullback eventually. All right, so that kind of was the scenario here in the overall market. All right, same blueprint. We wanted to see that rotation as the market started to digest this big rip post SIVB, and we didn't see it. Right? You guys remember, I mean, like a broken record, me screaming that if they're not buying the Tesla and the Nvidia and the Apple, there was no buying out there. Right? And then what we started to see was more and more put sweeper activity start to show up in those other areas. And that's the worst case scenario if you're bullish. Okay. So, and the reason why I say that now that it's a good spot, not only overbought on a price action basis, right? And a lack of participation, full participation from the overall market, right? So this is the equal weight S&P 500, still stuck in a menagerie, right? Kind of middle of the range here. All right. So you want to see this play catch up, even if the overall indexes aren't making a much headway, right? You want to see this play catch up because then underneath the hood, there should be a good amount of opportunities in individual names and setups that aren't as overextended as the majority of stuff you're looking at now. The reason why I think it's prudent to look for that now, as opposed to just the end of a bullish phase that we've been in and we go right back into a bearish phase, is because a lot of the stuff that was the catalyst for this bullish phase, okay, is still somewhat in place, right? So you still have things here that are really set up well for a continuation of this bullish phase, but I think it's going to show up in the form of more of buy the dip than chase the rip. Right? We kind of been seeing chase the rip up every day, just keep buying names up in a straight line. I think it starts to transition into buy the dip as opposed to chase the rip and see follow through. Okay. And here's one example of why, right? The hedge fund flows, the systematic flows, CTAs are still, well, they're definitely not bearish, all right? And still somewhat bullish, some extremely bullish. Here is hedge fund. We looked at it this morning as well. Hedge fund exposure in single names, individual names, okay? And there's a little more to this, right? As you can see, they are aggressively short, hedge funds are, in individual names, okay? What they've been getting long into this squeeze is a lot of macro ETF stuff and, more importantly, mega caps, okay? That mega cap trade was crowded. We got that little correction, loosened up a little bit, and now back as crowded as it's ever been. Right? I showed you guys that Goldman chart this morning. It's in the 99th percentile. Okay? Doesn't mean they have to blow up, right? It just means, again, it's a crowded trade, and the upside becomes a lot more difficult, right? There's a lot more risk there, especially if something happens. Like if something happens in mega cap tech land, some sort of bomb goes off, I don't know what could happen, but anything to attract some weakness, you'll have a ton of caught long exposure there, right? A ton. And that's risk you have to pay attention to, okay? Especially now off this rip. Ooh. So this is hedge fund exposure in single names. Mega caps are crowded, but what this, for me, what it points out, even more so than the mega caps being crowded, if the mega caps are crowded on the long side, I mean, according to this, they have zero exposure in basically anything else. Anything else. Right? So you name it. From financials to, I don't know, REITs to cyclicals to value names to whatever. As long as it's not mega cap quality, right? That momentum trade, they are actually significantly short in those areas. Okay. And if those areas start to outperform, what you're going to see is you're going to see those mega cap tech names more of being used as a source of funds to rotate into all the other stuff. Okay, so that's what we want to kind of start to look for once these indexes, once they stop chasing these indexes higher, and we sort of settle in. And again, we may be there or already now over the last couple of days. So those flows are bullish. This we pay attention to, right? This is kind of, this goes along with financial conditions, kind of a warning signal for conditions as a whole, right? A backdrop in a sense. And if you recall, just in case anybody's new to the webinar, when these things are widening out, meaning when this indicator is actually spiking or rising aggressively, what that tells us is that financial conditions are likely tightening. Okay. For whatever reason, the credit market is picking up something out there. Okay. And could be just the Fed being too tight or their rhetoric being too tight, whatever's tightening financial conditions at that time. And then once that fever, if you remember, we were talking, broke, that opened up the window for this bullish phase that we've been in. Now, again, I'm not even going to try to lie and say that I was expecting the whole entire move to happen in 3 days, right? I thought basically this whole move, not even this move, probably 3/4 of this move was likely going to run into possibly early mid-December. And that would have been the most bullish scenario I was looking at if we got that fever to break. It happened in literally 3 days. Okay. So now the problem is, again, if we're talking about the indexes in the overall market, we went from the top of the range where the Fed poops their bloomers, right? Where the Fed feels that, we may be over tightening, right? Credit markets, financial conditions are signaling to us things are getting a little too tight. We got to be careful because the last time we were this tight, we had that regional banking shit with SIVB. So we kind of got to tilt more dovish, right? Soften the blow out there. Take the foot off the brake, I guess is the best way to put it. And that's exactly what has happened. Now, try to pinpoint whatever reason was the main catalyst, right? Some people were talking about the refunding of the Treasury market. You had just recently the softer CPI. You had every hurdle that was in the way over the past couple of weeks go to the more bullish, dovish side, right? Hence why we saw what we saw. But again, just the simplicity of it, the fever broke. And once the fever breaks, even if we're not rolling over as aggressively as we have here, there would have been opportunities in sectors and names, even if the indexes weren't ripping to the upside. Okay. The reason why the indexes ripped to the upside, you had financial conditions and default swaps just completely wash out the whole move. Okay. Here are financial conditions here. I had another form of it here from Goldman, their financial conditions index. Right, so the unwind of that tightening phase was one of the more, and we hear this time, it seems like every time we go through something like this, but one of the most aggressive loosening of financial conditions we've seen ever. Okay, so it's pretty significant. Now, to the point I was making earlier, we're back down to that lower end of the range here where the Fed really doesn't want to allow conditions to ease any more than they have, right? Ideally, they want to keep this here until inflation's dead. Now, as I said this morning, you can make the argument because of the CPI or whatever else came out over the last week, inflation is on the verge of being dead. Okay. But logically, looking at the whole, right, taking a step back and looking at the whole situation, the Fed more than likely doesn't want to claim victory too early, right? That's the only thing that will make them look bad, look the worst out of this situation, right? What they rather do, and you hear from Powell constantly, is kind of keep this up here in this vicinity, right? We spoke about if this was going to move to the upside, something would break. The Fed's not looking to do that. As tough of a game as they talk, that ended in 2022. Okay, they talked a big game. As soon as that UK bond market, the gilt market cracked, it was game over. Okay, so they're more than likely we're gonna continue to see more of this. Okay, so what's that mean if we do, right? If we hang around at the lower end of the range, this bullish phase can continue. The indexes probably don't go anywhere to the upside, any material move to the upside, right? But net, we're probably choppy, sticky, kind of like we were just explaining. But if we see rotation, it could feel just as bullish, just in other areas, right? So for the bullish phase to continue, we don't need this to do anything of note. We just need these things to hang out and not tighten or rise aggressively. Okay, so we're at an interesting spot here, right? We got a little bit more room. We've been a little bit lower, but we're at an interesting spot where if you look at it based off this risk reward up at the index level, okay, is not too favorable, is it? Now, for this to roll over, right, for this to break this floor and head south, that would be implying, if you remember, like we said here, that a Fed put is in play, right? It would be an invisible Fed put because I don't know about any Fed put at play here. Okay, so if these broke this floor and rolled over, you would have a scenario where the market would continue to rip and the credit markets would be implying that they would be taking risk out of the market, right? This is a measure of the probability of default, right? If this is rolling over, usually the Fed put is at play, meaning that the Fed is backstopping things, and that's why the probability of default is going lower. Okay, so we're at an interesting spot. The likelihood is, the odds are we're not going to break down through this. We could go a little bit lower, but if we do, the Fed is going to utilize their main tool to tighten financial conditions and bring this back up to the range here. Okay, so that's what we're keeping an eye on here. But right now, again, as this thing has told us since the fever broke, we are in a bullish phase, and we should continue to look at the market as such as long as this remains range bound and choppy and is not rising aggressively. All right, and lastly, I didn't get an update yet because it's been kind of the same CTA flows. CTA flows lean bullish. They've leaned bullish throughout the whole week. They lean bullish for the month as of a week or two ago. We'll get some updates tomorrow and over the weekend to see where they stand going into next week. But this is what's going on. Okay, again, from the top of the market highs, where CTAs were basically all in and didn't really have much room to add any more exposure. When the market started to crack, levels start to break, VIX starts to break levels to the upside, they got to take down their exposure. right? So throughout the correction, they've taken down exposure all the way to the point where into these lows, they were net short again. Okay? And then as soon as the market turned, more importantly, the VIX and VVIX rolled over, they had to cover that short and chase. It's not a decision on their part. They have to do so. They have to do it. Okay. Now, this doesn't necessarily have to get all the way to up here again. Okay. A lot of things go into that. In other words, boxes have to be checked off for them to add exposure as they did back here. Okay. Certainly possible, but it doesn't have to get there. As you can see here, right? It doesn't go from one extreme to the other constantly. Okay, but while the flows remain bullish, again, what I touched on earlier, as opposed to a chase, even if the indexes are sitting around, they are more than likely to buy dips, right, and buy in a flat tape, which keeps the equity market bid, unless there's some greater force out there that takes over. What? Again, that exogenous headline event that gets financial conditions and credit default swaps to blow out, right? You get something that goes boom. You certainly have candidates out there that will obviously do that. And then as the market weakens, these guys will flip to net short again. Okay. So again, a lot of these they're all at interesting spots, right? I think the flows, as far as positioning are concerned, they still remain on the bullish side, not as bullish as they were, but on the bullish side, net. And the stuff that really unwound, financial conditions and swaps, maybe they're a burden, right? Maybe they're a problem for the indexes as a whole. But if we see that rotation, that doesn't mean the indexes have to roll over, right? They could just, again, the rally could slow down and we see rotation. We could see that RSP close the gap on SPX in the Qs. All right, so that's kind of where we stand right now going into, and Goldman had a nice write-up on financial conditions. Anybody who's a member, I posted it. If you're not familiar, you could take a peek, and they obviously explained it better. Okay. Something I wanted to point out, I think I mentioned it this morning, if not in the room, something Nomura's McElliott, who's been money, by the way, throughout this whole rally, was kind of touching on over the past week to 2 weeks. You have this, okay, which is the NASDAQ 100 covered call writing ETF. Okay. And supposedly a big part of the chase in these names, what added to the chase in these names was that the calls they wrote as part of their covered calls went in the money and they had to hedge. And that hedging creates positive delta hedging, buying in simple English. Okay. What happens tomorrow now is they need to go out and write calls again next month. Okay. That creates the opposite. Okay. That creates some selling. All right. As far as hedging is concerned in these QQQ names. Okay. So if you go back and you back test similar instances where the scenario played out in the same way, the probability, the odds were pretty high that you get some selling pressure in the QQQ names on that Friday, meaning tomorrow. All right, so something just to keep an eye out for. Maybe these things open up, you get a little gap up green in the Qs and you start to see some selling come in. It's something to keep in the back of your head, right? Maybe you see some put sweeper activity. You want to catch a quick downside move. I think, if I'm not mistaken, some of you probably remember better than I do. I think on an average is about 0.7% to the downside. So a little less than 1% to the downside is the median sell-off in these things in this scenario. All right, if the calls are covered, are they? You're talking about the calls that went in the money? Chuck, honest to God, this is above my pay grade. I'm not the right person to ask all the hedging behind this shit. But again, Nomura's Charlie McElliott, which you're probably familiar with. If you remember, that part of the note is in the Steamroom. And I think I posted on my regular Twitter too, in his language, which you probably got to read a good 3-4 times. But again, I'm just giving you the interpretation of it, because to a lot of us, that's the most important thing, because our heads can spin, right, in some of this shit. But the trade based off this ETF and the hedging behind it was a chase in the queues going into November expiration this Friday. And then tomorrow, a higher probability of some selling pressure because they are writing new calls for tomorrow. Okay. So that's the main takeaway from it. Just again, something to keep in mind, right? Because I know a lot of you guys have been scalping and trading intraday for the most part, especially if you trade these large cap names. And that's something you may want to keep an eye on if it sets up that way going into tomorrow. Anything else that I wanted to touch on before we just talk about some flow and shit? Let me think. I think that's it as far as Sharpies. You guys always want a Sharpies update. Sharpies did add a little exposure last week. Last week. We got it Monday because of the holiday. But no major change in the trend, right? So again, what they've been doing, Sharpies, probably I would say in this vicinity here, they started to rather aggressively take off some long exposure. They were long in a big way. They started selling from here into the rip and have continued to take down their long exposure. Again, they had a size long position in index futures. They basically took it down to zero, to the point where they were flat. And just recently added a tiny little bit. So in chart terms, I could probably dig it up, but I don't want to start digging because I might get lost. So it kind of looks like this, right? Sharpies now. I'm going to overlay my interpretation of Sharpies. Okay, kind of like that, right? So this was their last update, but we've seen it, right? We've seen that before. It wasn't a significant hit. No, it wasn't a significant hit. So what I'm saying is the net trend here has been bearish in regards to Sharpie positioning from this area here, kind of late summer. All right, so again, no major takeaway there. Remove drawings. And I think that's basically it on the stuff we talk about, right? So I just wanted to touch on sweeper activity because that's one of the more important things, especially for me, kind of get a gauge on whether we're in a squeeze, a bullish phase, a start of a new bull market, stock pickers market, right? Any new ideas. It's all generated from sweeper activity for me. And kind of what we've been talking about week in, week out. There really aren't any signs of a new bull market because we're not seeing any new names, new areas of the market being aggressively bought. Okay. It's been primarily the mega caps. They catch the most action, and that's an understatement. They catch all the size. They catch all the aggressive activity. There have been a few names that have seen aggressive chase. Uber, the action there has been pretty decent. Intel. Now, again, these aren't necessarily new names, right? I mean, Uber, we've seen flow in for ages now. Intel, from time to time, we see flow. You know, can you make the argument Uber is a potential new leader? Sure, right? Intel maybe has been out of favor for so long, maybe in favor. Is that a sign of new market leaders in the new bull market? For me, no. Right? And again, more importantly, it's not what they chased, right? We see forced buying, right? The reason why this move happened so violently is because of the forced buying that came in. Okay? Funds and players caught flat-footed with no exposure to equities or short. Okay? And then one by one, you get a soft jobs number, you get a soft CPI, you get no government shutdown, you get no holy war in the Middle East, right? One by one, all these potential risks out there kind of get deflated. And now, all these players are caught without any exposure to equities. They need to scramble and put on as much exposure as possible. And usually the easiest way to do that is via the options market, right? And the best way to do that is to bomb the ETFs and the mega cap names, right? The high beta names. So that is not uncommon. We see it almost always initially off a snapback move. Okay. It's now where you kind of you see the true colors of buyers, the real risk appetite from buyers. Okay. When that chase is over, when that forced buying slows down and kind of dries up, now what? Now what are you guys doing? Right? Are you buying dips in other areas on a down day? Are you finding new names, new sectors that may perform well and lead out of this correction? Right? So if this is a bear market rally, yeah, it's frustrating because you missed the bulk of it. If this is quote unquote just a bullish phase, kind of what that's kind of been my thesis, right? That we are in kind of just a range bound market with bullish phases and bearish phases, and bulls will get fooled in the bull phases, bears get fooled in the bear phases, right? People betting on new bull market, they are proven wrong. People betting on a crash, they're proven wrong. Net, where are you? You're in the same spot, right? The real market, especially, you're in the same area you were 2 years ago. Okay? So if this is just a bullish phase, what I'm getting at, yeah, it's frustrating because, again, at the index level, you more than likely missed the bulk of the meat off the bone. Okay? If it's a new bull market, there's nothing to be fun. If you're concerned or worried that you missed the start of a new bull market, you didn't miss shit. You didn't miss a thing. It didn't even start yet, if that's the case. You understand what I'm telling you? If this is a new bull market, it didn't even start yet. Okay? Because if this is a new bull market, what you're going to see the buying start to spill over in a really aggressive way into other areas. You're going to see new names. You're going to see more names. You're going to see decent breadth, right? You're going to see sectors moving in packs. So there's a lot of opportunity left if this is the start of a new bull market. And that's the point I'm making is you shouldn't be frustrated that you missed that opportunity if you're worried about missing that. Okay. If it's not a bull market, right, and it's the one of the other two scenarios where we're in the start of, we're in a bear market and that's just a bear market rally, or my thesis where it's just a bull phase, the opportunity here we need to focus on the opportunity in individual names because the index upside is a lot more difficult. Even if there is more upside, it becomes a lot more difficult. All right, so this bullish phase can continue for a bit if they do buy and rotate into other stuff. And it doesn't have to be new leaders, right? I mean, if they're buying Bank of America, Citigroup, or some of the regional banks, right, doesn't necessarily mean it's a start of a new bull market, but could be some major aggressive rotation and opportunities in a lot of those groups for a trade. Okay. And listen, I get it, right? And I'm telling you, I think that's the most bearish thing about this market. I know everybody's focusing on all the macro stuff and all the other stuff. I take one glance at the chat room in here or in the morning, and that's my biggest concern. My biggest fear is that everybody's just interested in the same names. And they forget what a stock market is. It's not a video game. You know what I mean? It's not your DraftKings account where you ride a hot team every day and place your wager. That may be how you treat it, but that's not what the stock market is. And the more crowded an area gets, especially when you're talking about that type of market cap in mega cap tech land, okay, the more crowded that gets and the more it overshoots, the more of a disaster it is when that gets unwound. So almost similar to when I had one foot in the bunker when AMC and GameStop were going higher and everybody just thought keep buying it. And if we keep buying it, we can manipulate the market and just these stocks keep going higher and higher and higher. And we're all going to make money, every single one of us, and be multi-billionaires. All right? Like that raises caution flags. Is very similar with these mega caps. And not even in a speculative way. People parking money in these names, right, I think is even more of a concern because they are not getting in and out like the speculative stuff. They just think they could keep parking almost like this, right? Almost like this. This is how they treated this. And this went on, and this is not equities, but it went on for a while. Okay? And when it finally was unwound, there's a lot of pain. Right? A lot of pain. And I mean, just think about how many times people bought dips in this on the way down. Because they think all you got to do is buy it, hang on, you got time, and you'll get your money back. There's been no sustained pain to any holding. Why would they sell? Yeah, well, and you hit the nail on the head, Khalid. That's a great point. They haven't really been forced to sell. 2022, they got a little kick in the balls, right? But they still had their job. They still had, you know what I mean? Fundamentally, they still had cash from the COVID fiscal shit. So investors didn't have to sell. Once they start losing their jobs, once the economy starts to get a little bit rocky and people worry about funds a little bit more, their retirement a little bit more, and then they start to see these things weak and continue to get weaker, it becomes a major problem. Now it may take time. I'm not saying there's going to be some crash in a day and it gets unwound that way. But just look at like TLT, right? Same approach. And it wasn't just your casual investor buying TLT. SIVB was basically doing that. and blew up. That's what happens with these trades when they become locks, right? What happened with these Magnificent Seven names, they're not buying them because they're bullish on the economy. They're not buying them because they're bullish on the equity market. They're buying it because they're concerned about the economy. They're buying it because they feel other equities there's too much risk there. You understand? They're treating the Magnificent Seven like treasuries. And that's a problem. Now, that unwind is not going to be the end of the world for a lot of people who aren't glued to those names continuously. You understand? Even if they just go dead and out of favor, people will get chopped up in them if that's all they're looking at and potentially miss a bull market in other things. And I know it's been talked about that, but that's the way the market works. What do you think? In the 90s, as these internet stocks continued higher and higher, there weren't people flashing or touting warning signals along the way as they continued higher? And the same rhetoric? Oh, yeah, you keep talking about these internet stocks crashing because of no earnings. You've been saying that for 2 years. And then when they did, it was, even that much more painful. Even that much more painful. And it doesn't mean that these names are going out of business or anything's wrong with them. They become fully valued, right? They become fully valued. All the good is factored in. If everybody's already in them, all the good is factored in. Once some negativity starts to surface, what do you think is going to happen? And right now, don't lie, every single one of us think there's no such thing as a possibility. What could happen that would be negative for these names? All right, what could happen? Microsoft raises guidance and buys back stock every quarter. It's a lock. All right, yeah, Nvidia, those AI chips, kidding me? For the next 25 straight years. You never see it. You never see the bearish case when the good is happening. All right, so that, to me, the reason why I'm even talking about that is, for me, that's the most concerning thing out there for me. Right? The rest of the market, I get it, right? Nobody wants to buy small caps. Nobody wants to buy these high growth names because right now there's no growth in the economy. The Fed has been tightening. The Fed has been raising rates. You just don't buy that shit when that's happening. Okay. But when that time changes, and it's going to change, it's only a matter of when for any of these groups, there's a ton of opportunity there. Why? Nobody owns them. Right? The complete opposite. Nobody's paying attention to them. Nobody owns them. Nobody cares about them. And that's how lengthy bull markets start. So that's why I'm not in that bear camp on the overall market or everything. It's not, right? Not everything is crowded, far from it. But the one concerning thing, and that's why every time we get a rally or a squeeze and those names lead, I just, it's a sour milk on that rally right from the get-go. It's okay if they participate, but they can't be where all the money in that rally phase, where all the money is going. That's not a healthy sign. It's not a healthy sign. And, maybe it could be just even like we saw in 2021. We talked about this, Sahil and I, you and I were talking about this. In the 2022 bear market, okay, the start of this year, literally the start of 2023, it's hard to envision it and remember it for where we are now with the Magnificent Seven, but nobody wanted to own any of those things, right? The last thing anybody wanted to buy was tech, related to tech. No, don't you dare buy tech when the Fed is raising rates. Every time rates ticked higher, algos were selling all the tech stocks. Okay? Positioning in those tech stocks was significantly damaged from where they were in the bull market prior, the COVID bull market. The semis were the most aggressively short sector of the whole market at the start of this year. At the start of 2023, 1 year. All right. So you say to yourself, well, how could ever get that bearish, or how can position get? We've already seen it not that long ago. We already seen it. Right. Yeah. And realistically, you're right. SIVB with the whole AI shit really just catapulted that whole group into the stratosphere. All right. Gradually, they started to get bullish throughout the start of the year, right? Without much of any participation. But then once post SIVB with the AI hype, that kind of took it to, especially NVIDIA, to no man's land. But again, at the start of the year, I mean, you look at like names. I remember like Amazon and Tesla. These names, oh my God, you would go on Twitter, these names, some people talking about Tesla going to zero. Amazon, here, look at this, right? Okay. Look what Amazon looked like at the start of the year. Okay. So think about like NVIDIA, Apple right now, whatever, right? Up here. Significantly crowded. Okay. And then this happens. 1 year. Okay. At this point here, nobody had an interest. Right? Nobody was in these things. And even better, because I remember the conversation I was having with a few of you, the October lows were here. Okay? Those are the October lows for the S&P 500 and the NASDAQ. Look what these names did as the market rallied off the October lows. They were a debacle. And more importantly, positioning was washed out. All right? So the timing is obviously extremely difficult, but that's the risk you take on when you're, just focusing on crowded areas. Okay. And, I've seen markets at the post 2000 where something like this went on in tech and mega caps. But while this was going on, there were bull markets in quite a few different areas. From small caps to home builders to medical. I'm just making the point that even though it weighed on the indexes and everybody's eyes were glued to just these names, everyone around me had no idea that there was a bull market under the hood in other places. So it doesn't have to be a complete disaster for the overall market if you're paying attention. But that's the main concern that I have now, is that it's, again, not just the retail player out there asking and talking and trading these names, but there's almost like, right, people they're creating systems, right, and philosophy, trading plans around these names and the indexes. And just when that happens and people think like they have a handle on a specific group or the overall market, oh, I'm just going to trade these names and the indexes because everything else is useless. I'm going to focus here, right? And I'm going to make my money here, right? That's usually when they go dead. That's usually when they go dead. And they get chopped up there while the rest of the market is nothing but opportunities and places to make money. That's usually how it works. So yeah, that's the only thing, right? Kind of my concern as a whole, and I think it's kind of a problem for the indexes because they're so heavily weighted. Uh, but yeah, could these things, could something happen? The Fed injects some liquidity, and these things have one more run. Of course, that's the market. There's no guarantees. That's the tough part. Otherwise, you just short the shit out of these things. If it was that easy, it's never that easy. Right? Like even if you shorted here on any of these, okay? Here's that downtrend, right? We were talking about. Even if you're holding short, now what happened? How do you hold through this? They don't make anything easy on the short side, especially in these widely followed names, heavily concentrated names. So that's the story, right? That's when you will, and you will hear it in my voice. You will hear it on the webinars because we'll be talking about a lot more names and setups. That's when you'll see a change in my tone on just the overall market, where you really will sense, if it's a word, the bullishness, me being bullish. Again, a lot of times when I feel more bullish about the market, I do better when the indexes aren't really even doing anything, because then it's the names and sectors and areas of the market that are performing. Sometimes you don't even need to pay attention to the overall market, and see here, there's so many different areas that are prime for, they're set up for it. Okay, it doesn't mean that it's going to happen now, as we all have seen. Okay, and there have been legitimate reasons why they've been so out of favor and neglected. But there's going to be a time where it changes. And don't get me wrong, it doesn't have to. I'm not talking about the Bank of America, or I'm not talking about beating down mortgage names or shit like that. You'll start to see a different type of growth out there, right? Different areas of growth out there. It's just not going to be the same tech names over and over and over again. And on that note, I did a scan, just looking at some of the names, because we talk about, right? They've been far and few, kind of like these nets, right? So here's one thing we all should keep an eye on, because I think it's, again, until the Fed really gets involved, starts rigging the game in a bullish way, you could see that the majority of names that look like this, okay, that have been in uptrends, look a lot different than anything else in that market cap size, right? They all are likely profitable and have some decent growth, right? And even though there's not enough of them, there's actually a little, right? There's not a lot of them at all. I think it's something we want to continue to look for. So, for example, you can either scan for it. It's easy to scan for these days. Or what, for me, especially more importantly, as sweeper activity comes in, you take a glance and see, all right, what's the buying here? Oh, wow. They got earnings. There's some growth there, right? That's more of a position swing candidate than, a hood. That, oh my God, that didn't even squeeze. I was ready to say that squeezing off a rally, or any of those names, right? You will see that a lot of the names, like even this name, right? And that's what I'm saying. It's kind of been stuck in a little consolidation, which makes sense of that killer move. But you look at the what's behind the move. It's not because there's no Fed injecting liquidity into the system, right? Because there's no game rigging out there. There's the stories just don't cut it. It's stories aren't attracting money. They gotta have numbers, right? They gotta have numbers and growth. And that's kind of the problem, right? Big picture wise, you have an economy that's been resilient, but really not explosive. Right? The IPO market has been dry. Companies of smaller size can't get access to credit like they have. So that's what creates the shortage. But as that improves, that's when you start to see more and more of these type of new leaders show up. Again, it's a gauge on the health of the overall climate in the market. You know, and you notice that, and this is kind of what I picked up on post 2000, right? I saw these smaller companies start to just look and act different than the tech and internet names everybody was paying attention to. Okay, it was all in different groups that not a lot of people were paying attention to. But what I noticed is every single one of those names were profitable and had a decent growth rate to them, right? And that's what was attracting buying and propelling their share prices higher. I mean, that's ultimately what the stock market's based on. That's all what the stock market's based on. Now, you go back to post-COVID, right? Especially once it caught fire where the Fed threw in the kitchen sink, you take rates down to zero, you inject liquidity, the government's throwing money into the system all over the yard. Doesn't matter. You waste your time looking at fundamentals, you can miss the 10 hottest stocks that week. Okay, it didn't matter. It was all story. You got a sexy story, SPAC, perfect. Let's buy it. You got any more? Because I got more money. All right, that's when the Fed does what they do. But without the Fed doing that, what you start to notice is a more realistic stock market. This LT with his BLTR. But, all kidding aside, LT, kind of what our discussion on the PLTR, right? If you do have high aspirations for the company, and I know you're in love with it, that's what you want to see, right? You want to see them not only become profitable like they did this quarter, but you want to see that growth can continue quarter after quarter. And that's what ultimately will push the share price higher. The story itself in this type of environment is not going to cut it. It's not going to cut it. There's a lot of sexy stories out there. A lot. All right. So why, what's behind the move? A lot of times you'll see it's fundamentals. Yeah, PLTR went profitable and actually had a pretty good quarter here, So beyond Carter, come on. Are you busting my chops or you got to be busting my chops with the fake meat? Let me tell you something. Beyond this $6.90, that's $6.80 too much, I think, for Beyond. Put in a bid for 10, put it at 15 cents. If you get hit, you get hit. Stock comes down to 15 cents, probably worth a flyer. Probably worth a flyer, Hey, look at it. The complete opposite, right? What I'm talking about here. And rewind to when this stock, Carter, was in play, right? When this stock was flying high and everybody was talking, it was all story. Oh, fake meat. Everybody's going to want fake meat because they don't like real meat anymore. Nobody gives a rat's ass about fake meat anymore, right? So now this is all short squeezes. That's all you play for here, are short squeezes. You need positive news to get shorts to cover because they don't want to get squeezed. And that's the upside. And it doesn't last because shorts come back and slap their shorts back on. You know? Yeah, AMD saying, you know, that's a bigger name, but same thing. They went through, what was it, a rough quarter or two? And then now this quarter, I didn't even pay attention to the quarter, but my take is they probably had some good things to say this quarter, right? But it went through some difficulty here, you know. And here's the trick too, though, right? For me, like it's in the names that aren't already owned that usually perform. Usually the smooth sailing will occur. You understand? So not to say that names that you guys are mentioning, like a shop, which had a good quarter their last quarter and stuff, can't do well, but there are bag holders in shop. I mean, you had a crazy bull market. Shop was a leader in that bull market, right? Had a crazy run. So you have people who own that stock at higher levels that as that stock starts to come back off good news and growth, players are likely going to try to get out. That's the problem with them coming back from the dead and what makes it so difficult. Whereas when you have a name like this and they start to get attention off numbers like this, you have this shit that happens, right? Or the name Sill, like that he was talking about in the room, the snaps. You know what I mean? Stuff like that. These type of names. The large cap or the more popular names or the over-owned names, again, their numbers start to turn. The stocks are going to start to do well, but you know you're not going to get those smooth sailing rips like you would. A lot of times you need the market too to help with those more widely held names. All right, look at this, like this SNPS. Okay, you had a correction in the market. Does this look like it even went through a correction? Look at this. Now, there's no sellers in this thing. Right? Nobody wants to sell this thing the way things are going right now. Right? There's no bag holders in this name. So that's why they hold up. Here's another one too that you guys have mentioned numerous times on these webinars. Annette, right? Let's see what their numbers look like now. Yeah, there you go. Another great quarter, right? And you guys have been talking about this Annette for a few quarters now. That I know. Look at this. AMD PE only 9 hours. Yeah, and the PEs, right? When there's no growth, those PEs start to matter. When there's explosive growth, you get away with those elevated PEs. But once growth starts to slow, they hit you over the head. But anyway, we're not there yet. There's some blueprint names, right, to use as examples. But when we start to see this market get healthy again, whenever that may be, we're going to see more and more of that stuff. More and more of that stuff. And it's likely they're going to use those mega cap names as a source of funds to go into all these other things when we get there. All right. But I'm going to wrap it up here anyway because I got to go. But very simply put, I think now, and it's good, right? Don't feel like you missed anything major, okay? If it's the start of the bull market, a new bull market, you didn't miss jack shit yet, okay? But we're at a point now, okay, where we're going to see some more true colors here, okay, from buyers, okay? That forced buying starts to dry up now. Are buyers for real in certain areas? Are they going to show up when this market, there's going to be a down day, there's going to be some negative news or there's going to be Powell remarks or something where the market sells off for a couple of days, do buyers show up, right, in different areas, in different spots, or do they crawl up back into a hole or flip to the put side, right? So I think we're really close to that point. We may not be there right now. Maybe there's a little more chase left. Certainly possible, because again, you can overshoot in both directions, and there's no specific level or anything like that. But I think we're close enough to start paying attention on down days. Is there buying coming in, and what are they buying? Right? Are they buying the mega caps again? That's probably not a good sign. Okay, that's probably not a good sign. And then we'll see. We'll see. What's going to be interesting is as we get into December. Okay, if the market hangs in here, or possibly even grinds a bit higher from here, do those hedge funds get squeezed? Right? How do those CTA flows look at that point? You may get to a situation come mid-December. It happens fast. Look how fast it happened. Come mid-December where you don't have any of those bullish pillars anymore, right? And you could get, instead of a Santa rally, a Santa poop on top of your head type of thing. So we'll see how it goes. But I think, again, the frustration part where things just keep going higher, chasing, I think we're closer to the end of that, and we're going to see some true colors come out of the bulls. Yeah, I saw that too, right? Buffett bought this series. Oh, you know what was interesting too? Please don't poop on my head, Santa. Tepper bought this guy. Did you guys see that? So Tepper, I think he bought a couple China names. But David Tepper of Appaloosa built a position in his Beaky. Now, this is a China tech name. Sort of did well when those China tech names, the K-Web names, got hot from time to time. I mean, this thing's been a hockey stick, right in the blade, dead down here for a long time. And Tepper took a position in this. So we'll keep an eye on the flow in this name. If we see those missiles, we see it in Micron when Tepper started building a position. Could be, part of that crowd adding. And may be worth a look. I mean, this thing's like a dead heartbeat down here. But it is China, so always keep that in mind. All right. Have a good night, everybody. I appreciate everybody stopping by tonight. If I don't speak to you, enjoy the weekend. I'll see all the Steamroom members mañana, and I think I'll see the most of you live tomorrow anyway on the broadcast. Oh, this is real estate. It's not tech. So this is China real estate. How did I think it was tech? China real estate. Why the F would he be buying this? God damn, Sahil. Definitely got to keep an eye on this now. That's even more interesting. Thank you for that, Sahil. All right, have a good night, everybody. I'll see you guys in the morning.